Okay, so this is part 3 of the supply and demand series. I'm not gonna try to take too long. Pay very close attention. I've got some examples I need to go through with, and hopefully I only have 1 or 2 more videos left, and then we'll get into some back testing. Without wasting more time, let's get into it. Okay, we are going to specifically focus on entry models, and they are like your market cheat codes. We're looking for setups on any time frame. Sometimes the market will give a setup that will look very similar to an entry model, and you can base your trade ideas or entries off of them. Now, let me reiterate the part of they can be found on any time frame. Sometimes people stick to a specific time frame specifically for that day or as their trading plan or model, and they use entry models to find their setups. Now, specifically in this part of this video, I will focus only on teaching you what you can use in terms of entry models and how they can look like, different variations, and how you can apply them. Now, not every entry model is going to be found on every single time frame specifically and exactly the way I show it to you, but I'm going to show you how you can find variations of them. But yes, you can still use the ones that I'm going to show you. Okay, so pay very close attention. I'm going to start off with some reversal entry models first, and then from there we're going to go to a little bit more advanced stuff. But the reason why I want to start off specifically with reversal entry models is because it's going to tie in very nicely with some continuation models, and I think it'll be a little easier to adapt to the continuation ones rather than going from continuation to reversal. Okay, pay very close attention. This is going to get pretty advanced. I'm going to try to keep it as simple as I can, but again, if you don't have an idea of what certain terms stand for, and if you haven't paid attention to the previous videos, it's going to be a little hard to adapt and to learn what I'm going to show you. Okay, so just keep that in mind. Okay, so the first type of reversal is called a climax. Now, a few of these that I'm going to show you are based off of what I believe to be either Elliott wave or Wyckoff, but it's very common and it's very important, at least in my opinion, to know. So imagine you're at an auction. The climax pattern is like the most exciting part of the auction when bidding gets really intense. In the selling climax, it's like everyone suddenly starts selling their items all at once, causing prices to drop quickly. This is like a big sale at a store where everything must go. In the buying climax, it's the opposite. Everyone starts buying like crazy and price shoots up. It's like when a hot new product comes out and everyone wants to get their hands on it. But these intense moments can't last forever. After the climax, things calm down and prices stabilize. This is like when the auction ends or when the store sale is over. The market enters a more balanced state until the next climax happens. So in simple terms, the climax pattern is like the most dramatic part of a shopping spree or an auction, where prices change rapidly due to intense buying or selling. But it's also a sign that price may start to range or accumulate afterwards. So let me show you a quick example of what something like that will look like. Now, quick example is it'll be a really fast shot either up or down. Now in this example, obviously you see very easily that price quickly took some liquidity out from the left side, right, and then starts shooting back up very fast and dramatically. Here it's the same thing, right? It might have tapped into an order block on a possibly higher time frame. Maybe it's the same time frame. It can happen at any moment and time and price, right? And all of a sudden price quickly shifts direction. So if you can, open up a chart and find a moment or time and price where for some reason just shifts out of nowhere. It might have been due to a news event that was forecasted for that day, or it's something that happens out of nowhere and price all of a sudden shifts and changes direction. Okay, so just keep an eye out for these kinds of price reversals. All right, now we have double top / bottom. Imagine you're bouncing a ball. The first time you bounce the ball, it hits the ground and bounces back up. That's the first bottom. Then you let the ball fall again and it hits the ground at about the same spot and bounces back up. That's the second bottom. In the world of trading, this double bottom is a good sign. It's like the market saying, hey, I've fallen twice, but I'm not going any lower. In fact, I'm ready to bounce back up. So when traders see this double bottom pattern, they get excited because it often means the price of the asset is about to go up. It's like seeing the ball hit the ground and knowing it's about to bounce back up. In a nutshell, a double bottom is a signal that the price of an asset has hit a low point twice and is likely to start rising. It's like a bouncing ball hitting the ground twice before bouncing back up. Now the same rule applies to double tops. It's like the market saying, I've tried to go higher twice, but I couldn't. I think I'll go down now. So when traders see a double top, they think the price of the asset might start to fall and they might decide to sell. Okay, nothing is for certain in what we do here, but it's a very good indicator of where price is going to head. And in this example, the first method, or the first way that you can anticipate price, or that you'll see, is one, you can mark out like your order block, right? And here you anticipate price to react off of this zone by finding support. Price comes down, right? And as you see here, this is the first bottom, and then this would be the second in terms of price changing direction from a bearish to a bullish trend. The second method would be waiting for a candle confirmation and then you'd enter, right? So here price is changing delivery from bullish to bearish. Price taps in, wait for a candle confirmation, and you could enter off of this one. Now if you don't see the candle, let me zoom in here for you right here. That is one way you can confirm the change of trend. Now I want to talk about this real quick. You can see price wicked out of the zone, but it continued down in the direction that it wants to go now. That's why I use body closures for invalidating my order blocks, because sometimes these wicks are just liquidity grabs, right? People put their orders here and then price quickly wicks them out and then continues going down. That's why I like using some kind of pattern or candlestick confirmation, right? If you would have just entered at the opposing candle, which in this case we would need a bearish candle, this white one right here, you could have entered there and you would have been fine, right? But that's why I don't really like trading with limit orders all the time, because this is something that can happen, and quite frankly it's very annoying, especially once price starts heading in the direction it's supposed to be going, right? So here's the first top and then here's the second top. That is how you can confirm it, by looking at the momentum also of that candle or the candles that are coming after that second top or bottom, whatever trend that you're looking at or whatever the next change of trend will be, right? Look at the candles, look at how big they are, look at how fast they react with the zone, how far from the zone it's reacting, etc., etc. Especially if price just quickly wicks into it, that's already a good sign of there being a possible change in trend. But look at the candlesticks, right? Look how big they are. Try to anticipate the movement, but as I always say or tell people, try not to trade counter trend trends or trying to anticipate these kinds of moves, because it can be very dangerous. But if you do decide to do it, use a higher time frame, specifically like anything from the 30-minute and up, and from there you can go ahead and try it, but I still wouldn't recommend it. Or you can combine it with a high time frame and a lower time frame, which you'll be seeing in these next few videos or slides. Okay, so let's move on. Now we have the pullback. So let's consider the example of a hike up a mountain. When you're hiking up a steep mountain, you don't usually go straight up without stopping. You take breaks to catch your breath, rest your legs, or drink some water before you continue your climb. These breaks are like pullbacks in trading. In a market that's trending upwards, like climbing a mountain, price doesn't usually go straight up. They rise for a while, which would be the climb. Then they fall a bit or move sideways, which would be the break, before they start to rise again, resuming the climb. This small dip or sideways movement is the pullback. The same concept applies in a downward trending market. But in reverse, it's like hiking down a mountain. You go down for a bit, then you stop or even climb a little before continuing your descent. I don't know why you would climb. Maybe there's something cool you saw at the top. I don't freaking know. The small climb or pause is the pullback in this case. Remember, just like hiking, trading requires preparation and caution. It's important to have a plan and to manage your risk appropriately. Now, here is an example of how you can use a pullback for your trades or entering a trade. Now, the part where it starts pulling back, that is what we would deem as the reversal, right? So what a lot of traders try to do is they try to capture this moment in price, right? Especially if on the higher time frame. Now, I have seen it work, but I do not recommend it, because let's say there's a fair value gap here, right? Some traders will try to short and then they get stopped out, right? Because the trend starts reversing. It's going down. You see the pullback, price fails to go back down to this lower low. And so what does it do? Instead, it creates a higher low here and creates a new high or higher high, right? So what you can do is mark out your fib from the low point to the lower high, which in this case would be the pullback. And you'll see price react off of this 50% zone, and then it'll continue up. Now, again, this is really, really hard to find or to trade, because you're assuming that the pullback here is not going to break this lower low. And you're assuming that instead it's going to create a higher low, right? That's if you're changing trend from a downtrend to an uptrend. And same thing here, where you're changing trend from an uptrend to a downtrend, right? The same principle would apply. Once you see that pullback, you're assuming that price is going to continue coming down. Maybe you saw a break of structure from this point to this area. Let me see if I can mark up something here, right? You're assuming that price, because it caused a change of character here, or a possible change of character, you're thinking that this pullback is not going to go past this high right here, right? You're assuming it's not going to pass this high right there, which, yeah, in theory could happen, but you would almost in a sense be counter trend trading, which we don't do. But as soon as you see that break of structure right from this area, from here to here, you could try anticipating that pullback because of this higher low point, but I would not recommend you doing that, because again, that's too risky. But as part of your analysis, maybe if you're doing an analysis on a higher time frame and you're seeing candlestick momentum reacting off of a 50% zone or in a zone up here, right? In this case, it would be a premium zone. You see some strong candlestick rejections and you see prices continuing down. You can say, okay, you know what? Maybe this is a pullback, but for a change in trend, not for a continuation. But anything can happen. I would prefer to wait for a second break of structure, which happened here. Again, it's up to you. Now we have the bull/bear trap. Very, very common. In the world of day trading, a bull trap and a bear trap are terms used to describe situations where traders are tricked into making a trade based on false signals. 1. Bull trap. This occurs when a trader or investor buys a security, it can be anything, stocks, Forex, whatever, that breaks out above a resistance level. While many breakouts are followed by strong moves higher, the security may quickly reverse direction. These are known as bull traps because traders and investors who bought the breakout are trapped in the trade. 2. Bear trap. A bear trap is the same thing. Traders sell an asset that breaks below a support level. While many breakouts are followed by strong moves lower, the asset may quickly reverse direction. These are known as bear traps because traders and investors who sold the breakout are trapped in the trade. In both cases, traders are trapped because they made decisions based on what they thought was a clear market trend, only to have the market move in the opposite direction. These traps highlight the importance of careful analysis and risk management in trading. It's always a good idea to look for confirmations of a trend before making a trade and to set stop loss orders to limit potential losses. In other words, just set a stop loss to limit further loss than what you would already have. So here is a quick example of what a breakout or a false breakout would look like, right? A bear trap. or bullish trap, whatever. So here, people that are trading breakouts or support and resistance, as soon as they see price break out of this level right here, some of them might sell, and next thing you know, they put their stop loss here and then they get taken out. Whereas if they were maybe combining it with a higher time frame, you'll see that price actually taps into this higher time frame order block, and you could wait for some kind of candlestick pattern confirmation. You enter, set your stop loss, and price should theoretically go into your take profit. Now, price doesn't always react in our favor, even if we do use some more confluences, because that's just part of trading. So don't think that just because you're combining a higher time frame order block, you're automatically a better trader than one that trades breakouts, because even then there are a lot of successful traders that trade breakouts and they probably make more money than you or me. But it's all on how good your interpretation of price is and how patient you are, your psychology, your strategy, etc., etc. And here's an example of one for buys. Price breaks out of the zone. You thought, oh, I waited for my confirmation, I'm going to enter here. But little did you know, price was actually going to react off of this order block, which would be known more as an inducement. You were induced to buy from here because you thought price was breaking out of this high or high point. Next thing you know, price starts selling off, right, going into the opposite direction. Whereas if instead you would have waited, maybe you would have used, if you would have used a higher trend confirmation by looking at highs and lows on a higher time frame, you would have realized price isn't actually moving towards the upside. Price is actually moving towards the downside. And you could have realized that if you just would have looked at a higher time frame or marking up swing point areas, major swing point areas at that current time frame. And I'll show you what that means later on. But if you would have done just a little bit more of an analysis instead of just looking at specifically order blocks, things like this can be avoided. So pay very close attention, because I will be going into stuff like this and breaking it down in a more visual way. That way you guys can understand and maybe implement it in any of your future trading strategies. All right, so now we've got some advanced reversal entry models. You're going to see some really, I guess, advanced stuff if you're a little bit of a new trader. But if you're a seasoned trader, you're probably going to be very comfortable with this. So if you're not seasoned, or if you're still fairly new to this game, I need you to pay very close attention to this and probably rewatch the video. And if you can, follow along with a chart, open it up and see if you can find something similar to what I'm about to show you. All right, so in this illustration, we're going to go over a few entry models or a variation of what price can somewhat look like. Okay, price doesn't always move like this very cleanly, right? But you can see a sort of a variation of it on any time frame. Okay, from a bullish to bearish order flow, you might have some breakup structures to the upside, right? It can be one or two breaks of structures, whatever, and then you'll see a possible change of character because price takes out a major low here, right? Or it could even take out another major low at the same time. Point is, it takes out a low and then price will pull back up, and this will be a new area of supply. And then price can go down, cause another break of structure, go back up and tap into this newly formed area of supply to continue going down. Here, same thing, but instead price will create some external liquidity down here, price that needs to be taken out after it taps into this area of supply. And here, same thing, from bearish to bullish, price will cause some breakup structures to the downside, pull back up, create some external liquidity, tap into this newly formed demand, back up, take out some liquidity from the upside, then goes back down, touches that newly formed demand, and then shoots back up. Here, same thing. It might just only create liquidity right from that simple pullback, then touches this area of demand and just shoots up from there. Anything can happen. Now, in this example, you'll see something similar, right? So you have a higher high, lower high, higher high, lower high, higher high. What does price do? Comes down, creates some liquidity, right? This is the low right here that gets taken out, okay? goes back up, creates some more liquidity, right? It takes it out as it's going back up, creates some more liquidity, comes back down a little bit, finally taps into our supply. And then once you see confirmation, or maybe you already had a limit order, you can take it from here and then write it down to this area or this area. It's all up to you. The main, I guess, driver of these types of entry models is this simple: a breakup structure towards the downside. Just one breakup structure towards the downside. It could be for a major high or a fractal high, or major low or a fractal low, whatever. One breakup structure. After that breakup structure, because it's a major swing point or area, some traders automatically assume, but with great probability, they assume that price is now going to change trend towards the opposite end. So what they do, they set that limit order off of an order block or supply zone. And in this case, it would be that supply zone. And then they set that limit order, and then they write down price to that next set of liquidity. That's usually the basis of these kind of reversal models, or really any reversal model. Okay, so I'm going to show you a few more examples, but again, pay very close attention, and if you have to, rewatch the video. In this example, we have bearish price going to bullish. So here you see a lower low, higher low, lower low, higher low, and lower low. So price finally comes back up, breaks this structure right here, right? This would be a major swing point. And what would you usually do in this circumstance is set up your demand zone. Price can sometimes create liquidity from the left to right, because this is some internal liquidity that gets created because it doesn't get taken out. Finally, price takes it out towards the downside, touches the demand, and then finally you can enter. You can either set your limit order or whatever entry model that you want to use that we went over with, and you can target this at a liquidity here or here. Very easy, very simple. This is pretty common as well. Again, you can use this on any time frame. So if you want to open up a chart, see if you find something similar to this, right? It'll look similar to this. It won't always look exactly like it, but it'll look very, very similar to this, especially if you're like on the lower time frames, which I've noticed entry models typically work better from like a 15-minute and down. You'll see something very, very close to this. All right, so here we have another type of model, right? So this bullish to bearish model will look something like this. You'll have maybe one breakup structure or two, doesn't matter, and you'll see very clearly that there is some internal structure forming before it breaks it. Then you'll see price slightly pull back down without breaking a major low just yet. Price will pull back up, then it'll create a change of character, or a possible change of character. Price goes up a little bit, makes a little small pull back here, takes out some liquidity here, right? Or an internal breakup structure will take out this low, and then finally tap into that supply or that newly formed supply area and then go back down. Same thing here, right? You'll have a breakup structure towards the downside, but before that you'll have some internal breaks of structure. Price will pull back up, won't break or take out any liquidity just yet, create a pullback, and then it'll go back up, taking out any external liquidity, and before touching this demand, so we'll create some more liquidity, right? Then it'll tap into this demand zone and then finally shoot up. Now anything can happen, right? Sometimes price can touch the one down here or up here. Anything can happen. You'll see like some kind of variation of this. Okay, so here is an example of what something like that could look like. Now before I continue on, I need to explain something that's very, very important. Lows and highs, major lows and highs, fractal highs and lows are at least pretty subjectively determined, especially if you don't use an indicator. Why? Because some people might consider this a low or a fractal low, or this one, or this one, or this one, or this one. It's up to you on what you think a low is or a fractal low is, but be careful because you might just choose the wrong one. Anyways, here you'll see that obviously the trend was bullish, right, because of this breakup structure. And then what do you see here? A pullback from here. It'll go back down here, create this little low, then goes back up, creates this little high, and then finally causes a change of character here because price broke down here. Goes back up a little bit, takes out this set of liquidity as you can see by this small wick, then finally taps into our order block and then goes back down. Okay, you'll see something very similar to this or very close to this. This can happen pretty frequently on the 5 minute and 1 minute, but again, it can happen on any time frame. I've seen a lot of people use a 2 hour for all of these kinds of examples, but personally, in my experience, I've seen this a lot on the lower time frames. Now we have one from bearish to bullish, right? So obviously this was bearish, right? From what you can see, price created a break of structure towards the downside, and then price finally starts moving up, causes a change of character. Some people use the wicks to determine it as a change of character. I don't. I rather use this candle body right here, right? This one right here. Price creates some more internal liquidity going up, and then finally shoots back down pretty aggressively, taps into this order block right here, and then price rejects really strongly towards the upside, targeting this set of liquidity or whatever set of liquidity you want. But like I said, most of these entry models or reversal entry models are really based off of just a simple break of structure, whether it's to the upside or to the downside. In this case, it would be towards the upside. Broke a major swing area or point up here, and then they use the order block or candle or whatever that caused that break of structure, right? All you have to do is go back down or go back up, obviously depending on the trend that you're in. Follow it, and which order block was it that created that break of structure or that change of character. In this case, it would be this one right here, because it's also the lowest point before this low. And then what does price do? Tap into it and then goes back up into its newly formed direction. Okay, so for continuation models, this is going to be a little more easier. If you want, again, open up a chart and try to follow along, see if you can find something similar. Okay, so here you will mark out your major swing points. Now this is on any time frame. It can be 1 hour, 3 hour, 4 or 5, I don't care, whatever time frame you want. You can mark out your major swing points, right? These are the points that are areas where internal structure is being created. So here for our bearish structure, you'll have your lower low, higher low, lower low, higher low, right? And the point is that at some point price will react, hopefully will react to that area or near those areas that are those major swing points, right? So price probably reacted to this supply area right here, and then same thing here, price reacts to this demand area, and then here supply reacts over it, right here reacts over it as well. And usually you want to pair it with an imbalance near those areas. It won't always have an imbalance, but usually if you can have an imbalance. And sometimes another thing that people do, or that I usually like to do, is instead of waiting for confirmation in that same time frame, I'll drop down a lower time frame and find one of those entry confirmations that again I've talked about in the I think part 2 video. Okay, so this example here reflects what I just said perfectly. You'll mark up your major swing points, higher high, higher low, higher high. We have some trendline liquidity here and some liquidity that got built here, got swept from this break of structure, this low here, taps near that gap and also in that order block. So again, the order block is one that you usually want to mark up. That's right before that gap or imbalance. Price taps right into it, or if you want to be safe, you could set up your limit order or wait for price confirmation to reject off of that gap, and then you can enter and target that trend line liquidity. Okay, now another thing that I should add is price might not always reach that major swing area or major swing low or high, whatever. Sometimes it'll be that structure that's created afterwards, right? Because price already reacted to an area off of here, okay? But if you set your stop loss, you are always more than welcome to set it under that major low or major high, but in this case it would be that major low. Okay, so just keep that in mind. Sometimes price won't reach this area down here, but it will reach the one up here. And here you can see I marked up again my major swing areas, but I use my Fibonacci tool to confirm my next higher low, which would be this one. And then I marked it from my higher low to this lower low, and then confirmed it because it landed perfectly, rejected perfectly off of this 50% zone or equilibrium, whatever you want to call it, right? And then I marked up my next one because it was pretty obvious from here. This is just my next major swing low area. I marked up my liquidity. Price got taken out as it was going up. This is the gap here. As you can see, price was already filled from this point right here. And then this was the only opening gap. No gaps up here. That's why I didn't choose that as my zone. But what you could have done is maybe you're on a higher time frame. These candles right here, these 3 candles can mean an entire candle on a higher time frame. Anyways, price taps into it, rejects, and it goes back down, forming more major swing point areas. In this case, this would now end up being our major higher low. Now for this entry model, you'll see price creates a lot of liquidity before heading in its original direction. So here you'll see for our bearish continuation model, you have a couple breaks of structure, price creates some external liquidity, and it'll either tap into this zone here or the one above it. That's why you need entry confirmations right before getting into your trade. Same thing here, it'll create some external liquidity, and it could tap into a major area down here, breaking through that first major structural point and then heads back up, or it could take out this low right here and then it'll go back up. Entry confirmations are very important, ladies and gentlemen, when it comes to trading. That's why I say and preach so much that entering limit order style is not always the best. Sometimes it can help you avoid those unnecessary losses, but it's up to you. So example, you have your higher low, lower low, higher low, right? And then you have that liquidity getting built up here, gets taken out, major swing low, price starts going up, taps into that order block right here because there's a small little gap. You could have entered as soon as price touched it and then started heading back down, targeting all this external liquidity right here. Very easy, very simple. Same thing here. Now here, I try not to add too much stuff to it, but obviously you can tell that the trend was bullish, and I marked up this gap. Now the gap could have been from here. You could have marked up the gap just from here specifically, but this is a really, really good example. Why? Because I chose this candle because it was already covering the gap down here. So I thought, you know what, maybe this candle would be the one that I want to mark up, but I wanted to be extra safe and marked up this gap right here and instead set my limit order right here. Now I don't know if you can tell, but it looks like price didn't actually tap on my order block, but it actually did. But it barely tapped it in. Imagine if my spread was off of by 1 pip. If you don't have 0 spreads, you are more better off by setting your limit order just above the gap that is near your order block. Why? Because this right here, for a lot of people, you probably missed your trade and you're already screwed. But if you would have used instead an entry confirmation, you would have realized, hey, this is an engulfing candle. It tapped into that gap right near my order block. It looks like it did touch this order block that I have set right here. I'm going to enter my trade around this candle. Very important. This is why you should practice what I'm trying to teach you here. Entry confirmations can be extremely useful, especially if you don't want to miss out on any trades. All right. Okay, so here it's going to be a little bit more advanced because we're going to be combining higher time frames with lower time frames. So here you'll see price, right, is heading towards the upside, create some liquidity before going down, and then it'll tap into a higher time frame order block from which you will drop down to a lower time frame, right? As you can see, price might react to some of this external liquidity, but it'll tap into a lower time frame order block before heading back up. Same thing here, price is coming back down, creates some external liquidity, and then as it's going back up, creates a little bit of temporary internal liquidity, gets taken out or gets swept by this higher time frame order block. Price goes back down, maybe taps into an order block here, and then temporarily starts going back up. But if you drop to a lower time frame, you might find an order block, or in this case it would be a supply zone from which price taps into and then starts going back down. And here is a quick example of what that could look like. So let's say you're on the 15-minute time frame, just as an example. Price is going back up. Generally, it's going back up. Price will tap into that 15-minute order block. You can drop down to, let's say, the 3-minute. And the only reason why I use the 3-minute is because it's very hard to get all this price into one picture, all right? But same order block, just a different color. Drop down to the 3-minute, okay? And as you can see here, this was a lower time frame order block because there's all this liquidity. Price finally taps into it and then heads back into its original direction. Imagine combining this with an extremely higher time frame, maybe like a 4-hour time frame, right? You drop down to, let's say, a 15-minute time frame. Imagine all the pips, all the money you can get. Why? Because you're holding the trade for a lot longer, okay? That's why it's extremely important to use multi-time frame analysis if you want to catch those really nice entries. But this is a little more advanced, okay? Don't get me wrong. Sometimes you'll get stopped out a lot more than what you'll actually be getting into. But if you have a good risk to reward, you'll make some really good money. Generally, guys, anything is risky. Anything that we do is risky, especially when it comes to trading. But if you can learn and understand how to combine higher time frames with lower time frames, you will be making some crazy money. Now, same thing here, except now I'm using the 15-minute and the 5-minute, and we're going to start off with this chart right here. I have my order block marked up here, okay? Price taps into it, and as soon as price taps into it, I drop down to that lower time frame and I mark up my supply zone, and price barely taps into my supply zone, barely taps into it, and then it continues going back down. Now, it's not always going to be like this, right? Sometimes price will like trickle down a little bit and then come back up. Sometimes it can be this quick, okay? But anything is possible. Or as you can see, there's this small gap from here to here. Price taps into that small gap, then touches that order block on the lower time frame, and then continues back down. And as you can see, it creates all this liquidity, right? And then finally gets taken out after it starts going back up. And then finally, again, taps into that order block or that supply zone, gets back down, and then retraces up again. But this is all on the lower time frame. Obviously, from the higher time frame, it's going to look a little different. It's still the same liquidity. Taps into it on that higher time frame, drop down, mark up your order block, wait for price to retrace into it, and then continues back down. Now, in this case, price did reverse up here, but if you were smart enough, you would have taken some partials. Let me see if I can mark it up for you. From here to here, and then maybe you could have taken it from here to here. Okay, anything can happen. Be smart. Don't be too greedy. And again, guys, don't go crazy if you end up losing a little bit of money here and there. The point is to be profitable by any means, right? That means by having a high strike rate. Maybe that means by having a lower strike rate. High risk to reward, a low risk to reward. Whatever it takes. You don't have to be one of those crazy risk to reward traders. I mean, look at Doyle Exchange. I love using him as an example. He doesn't go for these crazy risk to rewards. His risk to rewards, a lot of them have been 1-to-1s, and he's a really good trader. Okay, and if you haven't checked him out, check him out. But all I'm saying is, especially starting off, try going for 1-to-1s first, and then after you see that you've been hitting 1-to-1s really well, try going to 1-to-2s. And if you see that you're hitting those well, try going to 1-to-5. A 2 risk to reward, so on and so forth, right? Slowly build up to it. Don't go from 0 to hero in a matter of a day or two. Okay, this takes time. Be patient, but I promise you it's worth it. I promise you it is. Now, with that being said, that concludes this part of the series. Like I said, I believe I only have one more episode to go after this, and that will be explaining the trading plans. I have some really good stuff that you guys are really gonna like. I mean, you can use these trading plans because not only have I done the back testing for it, these are plans that I use, and I still have more trading strategies that I'm making, because I think the best way to diversify, at least in this space when it comes to trading, is to have multiple strategies that actually work. Master one, make another one, master that one, make another one, so on and so forth. Okay, you're really gonna like what I have coming up. Either way, I just want to say thank you for making it to the end of this episode. I hope you learned something. I hope you can implement it. And yeah, guys, I will see you guys real soon. Keep trading and stay blessed. Peace.